Silver investors. When silver drops 3% out of nowhere the day before a major inflation report, that is not random volatility. That is a message, and if you do not learn to read that message, you will spend the next decade donating your money to people who already know tomorrow's number. I'm OG John AG, and in this video I'm going to walk you through what a pre-CPI silver smash really is, why the timing is so suspicious, how options flow exposes the fingerprints, and what it tells us about the war between insiders and everyone else going into the next phase of this cycle. Segment 1, today's crime scene. What just happened to silver? Let's start with the facts on the screen, not the excuses on TV. Today, silver didn't just drift lower, it dropped hard. You're looking at a move on the order of about 3% intraday, with price slamming down into the mid-76 and closing around there, roughly a 2 or 3 slide from the morning levels. No war headline. No mining disaster, no surprise policy announcement, just a normal session on the calendar. Except tomorrow at 8:30 a.m. Eastern, the Bureau of Labor Statistics is scheduled to drop the next CPI inflation print. That's the report the entire bond market, the Fed, and every macro fund on the planet is watching. So ask yourself, why does silver suddenly get taken to the woodshed 24 hours before that number hits? Why now? Who benefits from knocking price down right before a potential inflation shock? This is not just volatility. This is a setup. Segment 2. The leak theory, when markets move before the news. Let's talk about the leak without being naive about how this system actually works. The official story says nobody sees CPI before it prints. Data is secure, embargoed, locked down. The real world says bond markets, futures, and options routinely move the day before big releases. The biggest banks and funds don't wait for CNBC. They position ahead of the event. You don't need a literal manila envelope slid under a door. You just need hints from order flow, early whispers from survey data, political pressure that tells you which direction the narrative needs to go when you see a sudden concentrated futures dump in silver on no legitimate news. The day before CPI, the simplest explanation is not random. It's front-running. Smash the metal now so you can load up on cheap upside exposure before the inflation number forces everyone else to wake up. That's how you turn information asymmetry into money. Segment 3, the shakeout. Why they needed you out first. If you are an insider and you expect CPI to come in hot, higher than the market's comfortable forecast, here's your problem. At elevated silver prices, call options are expensive. Retail traders and small funds still have long exposure from the recent run. The tape looks strong. Everyone feels smart. So what do? You cut the legs out from under the market. You hammer the futures market with a block of sell orders in a short window, drive price through obvious support levels where retail traders placed stops, force liquidations, margin calls, and panic selling. Result, the chart looks broken. Social media flips bearish. Weak hands dump their positions at a discount. Now the real trade starts. Calls and leveraged long exposure are much cheaper. You can quietly build a position for a potential post-CPI moonshot without paying full price. The crash wasn't an accident. It was a clearance sale engineered by people who don't want you standing in front of them when silver rips. Segment 4, options flow, where the fingerprints usually show up. If you want to know what the smartest money is doing, you don't listen to what they say. You watch where they put risk on. In situations like today, it's common to see out-of-the-money calls on silver spike in volume right after or even during a dump. Strikes clustered around the pre-crash price, the levels silver would need to reclaim if it rips on a hot inflation print. Why options? Because, for a relatively small premium, you control a huge notional amount of metal. If silver explodes higher on CPI, those calls can go 2x, 3x, 5x in days. If you engineered the dump, you literally created the cheap entry. This is how the game works. Smash futures to create fear. Scoop calls while retail is frozen or selling. Ride the reversal when the macro catalyst hits. Most retail traders only see the first part, the smash. By the time they realize what happened, the option's already printed, the insider's already cashed out, and the move is over. The pattern from this video's theme is simple. Crash, calls, CPI, reversal. Once you see that pattern, you can't unsee it. Segment 5, CPI mechanics. Why silver cares so much about one number. Now let's zoom in on why that 8:30 a.m. CPI number is such a big deal for silver. The entire pricing of Fed policy, interest rates, the dollar, comes down to the dance between inflation data and growth data. If CPI comes in hotter than expected, real yields drop because inflation is higher relative to nominal rates. The dollar can weaken as markets start to price the Fed being behind the curve. Hard assets like gold and silver suddenly look like underpriced insurance. If CPI comes in softer than expected, the market can breathe a little. The Fed looks more comfortable staying higher for longer. Metals get less immediate urgency as hedges. In other words, this single number can flip the narrative from no problem, inflation is tamed, to the Fed is trapped again in one morning. If you believe that risk is real, you don't wait until the number prints. You position before, especially if you have reason to believe the consensus is wrong. That's why a brutal silver smash right before CPI is so suspicious. It lines up perfectly with a buy the blood, profit from the print strategy. Segment 6, pattern recognition. We've seen this movie before. This is not the first time this script has run. Look back at big Fed meetings, surprise QE announcements, elections, major payroll and inflation reports. Over and over, you see a pattern. Pre-event smash in gold or silver on no real news. Retail flushes out, sentiment turns bearish. The event hits. Data or policy turns out more inflationary or more dovish than officially expected. Metals launch higher, leaving panic sellers behind. The video you sent is literally connecting those dots around this specific CPI date. Crash into the event. Suspicious options action. Expectation of a move up, not down, if inflation surprises. Once you understand this pattern, you stop asking, why did silver fall today? You start asking, who needed silver lower before tomorrow? Segment 7, liquidity, algos, and why the violence is so fast. One of the things that scares people is the speed. On days like this, silver can drop multiple dollars in minutes. Key levels snap like they weren't even there. That's not grandma selling coins. That's high-frequency algorithms slamming the futures book with size, hunting for stop-loss clusters sitting just below obvious support. The algos scan the order book, detect where retail and smaller funds place stops, fire a concentrated burst of sell orders to punch through those levels. Once the first wave of stops triggers, the cascade feeds on itself. Forced liquidations, margin calls, more panic sell orders. Then, when the damage is done and retail is out, those same systems quietly flip and start buying into the weakness. From the outside, it looks like chaos. From the inside, it's a harvesting strategy. You can't outrun those algorithms in milliseconds. Your only edge is to zoom out and recognize this is a designed flush in front of a known macro event, not a sudden collapse in real-world demand. Segment 8, the macro backdrop. Why leaks and manipulation matter more in 2026. All of this would be less important if we were in a normal, low-debt, low-tension world. We're not. We're in a post-2020 money-printing world where M2 exploded and never fully normalized. A post-BRICS realignment world where new trade settlement systems backed by gold are emerging. A high-deficit world where the US and many others are rolling over trillions at higher rates. In that world, CPI doesn't just tell you about grocery prices. It tells you whether the Fed is losing control of the narrative. It tells you whether the dollar can stay the cleanest dirty shirt or not. If inflation refuses to go back to 2% while debt keeps climbing, the system only has ugly options. Keep rates high and break something. Cut rates into hot inflation and risk credibility and currency value. Either path ultimately favors hard assets. That's why insiders care so much about being early on every CPI shift. And that's why you see such violent behavior in silver and gold before those prints, not after. Segment 9. How a serious silver investor should think about this setup. Let's bring this down from theory to practice. If you are a serious silver investor, you're not here to guess the next 30-minute candle. You're here to survive the games, accumulate in smart zones, avoid being the exit liquidity for someone else's leak. How do you do that? Separate time frames. Day traders live and die by intraday moves. That's their choice. Long-term stackers focus on multi-month and multi-year structures. Treat pre-event smashes as information, not commands. A big dump before CPI is a clue, not an order to sell. Ask, what are they positioning for? Instead of, what am I supposed to fear? Guard your leverage. If you're using heavy leverage, these engineered flushes are designed to blow you out. Size position so you can survive a manufactured 5-10% move without panic. Use panic, don't join it. If your thesis is that inflation risk and debt risk are not going away, then scripted dumps ahead of inflation prints are potential opportunities, not automatic get-out signals. You will never beat the insiders at their own timing. Your edge is refusing to hand them your medal every time they run this playbook. Segment 10, final word, what you need to watch tomorrow. So what do you do from here? You don't guess the number. You watch the reaction. Tomorrow, 8:30 a.m., Eastern CPI hits. The dollar, bonds, and silver will all move at once. If CPI is hot and silver rips back through today's crash zone with force, you'll know this was a setup. You'll know the options buyers were right. You'll know the dump was about positioning, not fundamentals. If CPI is soft and silver bleeds lower, you learn something else. The insiders either misread the number or they were hedging wider macro risk and are happy to dump more. Either way, you don't watch this like a victim anymore. You watch it like evidence. You've been watching John AG here, and I'm OG John AG. If this helped you see today's silver crash as a pre-CPI operation instead of a random red candle, hit like. So this kind of breakdown doesn't disappear. Smash subscribe with all notifications on and drop a comment, crash or setup. Tell me where you stand after the CPI prints, because on this channel, we don't just react to the move, we track who needed that move before the number hit the screen.